Hello, we're excited for the opportunity to introduce you to Buckeye Grilled Cheese. Everyone loves comfort food, and grilled cheese is one of the most nostalgic, satisfying, and universally appealing options you can offer. Our team is launching a food truck in Lakewood, Ohio, with a menu offering playful variations off the familiar and much-loved classic, the grilled cheese sandwich. To launch our Buckeye Grilled Cheese, we're asking for a $150,000 investment to cover startup costs and bring it to life. We're targeting Lakewood because the Lakewood Truck Park is a centerpiece in the Lakewood community, offering a rotating schedule of local food trucks year-round. It's a young and diverse community just 6 miles outside Cleveland, which allows us to leverage its large population without the higher costs associated with a major city. With a familiar offering and an affordable price, our food truck will target both young professionals in Lakewood as well as the large population of young families in surrounding areas. The Cleveland area is home to hundreds of events that include food trucks each year, so with built-in foot traffic and much lower startup costs than a brick-and-mortar restaurant, over the next few minutes, we'll detail why we believe this concept stands out and how it fits the market and the growth potential that we see ahead.
So why we win in a competitive market? Well, to start with the Buckeye Grilled Cheese, it's global comfort. It's got many different offerings from Korean, Mediterranean, Italian, Mexican, and American grilled cheese with an opportunity to have vegetarian. It caters to the demand of, present people who are wanting different options. And then on top of that, we have signature pairings, baking our own bread with fire roasted tomato, which kind of develops a unique brand signature with some strategic location. So our picking was Lakewood Truck Park, Cleveland metro area, with a high foot traffic, a lot of events, and there's just year-round demand. On top of that, it's a scalable model. Kind of start with one truck, potential for expansion and eventual franchising, whether it's across the state of Ohio, into Cincinnati or Columbus, or just throughout the country. And so with a relatively high margin, it's very scalable, very investor ready. Just taking a look at the market overview, between 2019 to 2030, the market size in 2025 of the food truck industry was about 4.42 billion dollars, with the estimated market size in 2030 to be 6.06 billion, according to Mortar Intelligence. So the industry net margin, it's going to be an average of 6 to 9%, with our forecast achieving 8 to 9% within 2 years, and then a break even within 18 to 24 months at about 80 daily sales on estimate. Capital efficiency, startup costs, it's pretty lower end compared to the restaurant industry at about 80 to 150K compared to the 300K. And then some return on investments, our projected IRR is about 11.9% on the upper end of the restaurant industry, averaging around 8 to 12%. And overall, it's just going to be popular with younger consumers. A lot of people like to get outside nowadays and experience, all kinds of different foods, and a food truck is a perfect place or perfect, business to be able to put in front of those consumers. You can, if you wanted to go to a local grocery market, be in the parking lot, or if you want to go to a brewery, it's opportunity to be, movable, and really grow substantially. So we're going to be able to move on to Maria, and she's going to
Permit and licensing costs are dependent on several variables such as location, risk factor, truck size and weight, as well as staff size. Here we can see the breakdown for Cuyahoga County, which encompasses Lakewood, Westlake, and the greater Cleveland area. The total cost would come to just over $1,300, which would be an upfront cost prior to being able to open and operate our business. As mentioned, one variable is location, which is often broken out by county. So if we did expand down here to Columbus or further throughout Ohio, as Brayden discussed, these costs would need to be reevaluated as individual counties could require additional permits and licenses. Another requirement in order to begin operation is insurance. As we all know, insurance can vary quite a bit, so we are budgeting for higher than average rates. For additional protection of your investment, we are also budgeting for additional insurance that is not mandatory to ensure our operation and your investment is insulated against any unforeseen events. This protection comes out to just about $355 a month. I will now pass it off to Adam for a breakdown on average order values and costs.
Thanks, Maria. I'll now take you through the average order value and cost breakdown component of our presentation. Our capital ask is just under $150,000, which will cover the food truck, all kitchen hardware, and a cash cushion equal to 6 months of our operating expenses to ensure survival in year one. Our focus here is on quality, so our cost position will be slightly higher than the industry average, but our price point to consumers is well within the acceptable range of the industry, all while maintaining healthy margins on our end. We're assuming a conservative order mix where we have 3 different order types. A meal combo, estimated to be 65% of our orders, grilled cheese and beverage, 25% of our orders, and a grilled cheese on its own, 10% of our orders. Our year one weighted average order value comes out to roughly $16.37, compared to an industry-wide average of $10 to $20. Our food cost assumption is 38% of our average order value. Our industry-wide average is 28 to 35%. The focus here, again, is on premium ingredients. Given our cost points being a little higher, we have edged our average order value to be just over the midpoint of 15. Excluding transactional point of sale costs, our average order margin is at 62%. Now on to our 7-year profit outlook. The food truck industry is in the quantity growth stage of the industry life cycle with an expected CAGR of 0.9% through 2030, compared to our CAGR of 3.4% between 2027 and 2032. As the country continues to replace work-from-home standards with back-to-office initiatives, the market is primed for another strong surge. As more people head back to the office, there's a ripe opportunity to partner with local businesses and become a lunch option throughout the work week. Given the competitive nature of the food truck scene, currently 15,000 establishments across the U.S. and growing to 22,000 by 2030, we will take on cost increases without passing 100% of the cost onto our customer base while still maintaining strong profitability. Onto our revenue growth estimation and operating margin trend. So as stated on the previous slide, our CAGR for sales growth is 3.4% between 2027 and 2032 compared to the industry growth CAGR of 0.9%. We began our measurement here starting in 2028. The growth from 26 to 27 looks extremely artificially inflated, given that we only expect half of our annual demand to come in year one, compared to a full year of established demand in 2027. Our operating margins are very healthy, and between 2028 and 2032 are expected to stay above 11%, even as we absorb cost increases and we maintain our ability to not have to pass every single dollar for dollar onto our customer base. With that being said, I'm going to hand this off to Tyler, and he's going to take you through the NPV and IRR.
Thanks, Adam. Continuing the financial discussion, I'll be going over 2 key metrics for our potential investors. Starting with NPV, we are projecting the net present value of all future cash flows for this food truck to be valued at $18,828. In plain English, this means we expect your investment will return money. NPV can be used as a go or no-go decision-making tool for investors, where a positive NPV projects you will have a return on your investment, 0 would be break even, and negative would be losing money. So we are in the green on that assumption. Next, moving to IRR, or the internal rate of return. Given the initial investment in the 7 years worth of cash flow that we're projecting, we are calculating an IRR of 11.9%, which is both on par with the restaurant industry overall and exceeds the cost of capital to us, which is 9%, 4.5% for the risk-free rate, and then a 4.5% market premium for the money that we are borrowing, making this an attractive investment. The IRR is, like I said, on par with the restaurant industry overall. However, this food truck only requires half of the upfront investment compared to a traditional, restaurant in a storefront or brick and mortar location, making it attractive for people who want to get in the door with a solid return, but only front a smaller amount of money. Moving on now to the break-even analysis, our financial model projects that we will break even in our second year of operations, which is 2027, and be profitable by year-end 2027. This break-even was calculated by taking our fixed expenses divided by our contribution margin per unit, which is the revenue minus variable costs. So $70,739 divided by that contribution margin of $4.34 returns 16,299 units sold in order to break even. This comes out to 53 units needing to be sold per day in order to attain break even, which naturally has large peaks and valleys. In the summer months, we expect to be doing way more than 53 transactions per day. And then in the wintertime, some of those weekdays we'll be doing much less. Year one, we will be at a loss, so obviously not attaining break even, which is not uncommon for a startup or a food truck, but we're going to have more than enough cash on hand from our initial fundraising to weather that loss and truck on into 2027. That concludes our presentation. We have a few slides in the appendix, but thank you for your consideration.